Hello, everyone, and welcome to another Masterclass in Financial Analysis brought to you by Calcbench. I'm your host, Matt Kelly, editor of Radical Compliance, and in today's class, we're going to consider a few ways that financial analysts and investors can prepare your portfolios for periods of economic recession. Now, to be clear, nobody at Calcbench is predicting a recession anytime soon, but one is bound to happen eventually, and after 10 years of growth in the United States, the arrival of recession might not be something that financial analysts have thought about for quite a while. So this masterclass is going to walk through some techniques analysts can use when you do believe recession is coming and you want to position yourself smartly to reduce the loss from recession as much as possible. So we have a quick note on logistics here before we get started. First, this masterclass has been pre-recorded, so we are not taking questions from the listening audience. That said, we do love questions. We're happy to answer any that you have. Simply send us what's on your mind to info@calcbench.com, and somebody will follow up with you as soon as possible. And for those of you with one eye on the clock, we expect our session today to last probably about 35 to 40 minutes. So here's what we're going to do. We are going to divide this class today into two halves of roughly 20 minutes each. First, we'll have a guest speaker, Jason Voss. He is the CEO of Active Investment Management Consulting. He's going to give us his 3 principles about how to prepare a portfolio for recession. Then we'll shift gears to our second speaker, Pranav Ghai. He is the CEO of Calcbench. Pranav was also a financial analyst himself earlier in his career. He'll join us to give some specific examples of how Calcbench's data analysis tools can help with some of the principles that Voss outlined in the first half of our segment here. So now let's introduce our guest a little bit more in detail. As I mentioned, he is Jason Voss, CEO of Active Investment Management Consulting, and he is a longtime player in financial analysis and portfolio management. Prior to launching AIM Consulting earlier this year, Jason was the content director for the CFA Institute. He's also been a portfolio manager for the Davis Appreciation and Income Fund. He co-founded the Sarasota Institute, that is a public policy think tank. He's written several books on investing, including his latest, which will be coming out on October 29, Return of the Active Manager, that is co-authored with C. Thomas Howard. So look for that soon. And yes, that last line of the bio is real. In Jason's spare time, he studies the art of ninjutsu. So, Jason, hello, and thank you for joining us here today.
Yes, Matt, thanks very much for that kind introduction. I'm really happy to be here.
So let's start with an overview. Before we get into any specific recommendations about portfolio management, I wanted to ask you to give us your broad view about how portfolio managers should approach recessions. And as I said before, recessions do happen. We don't necessarily know when. We can often see them coming with some sense of advance notice. But if a portfolio manager is thinking, okay, I think recession is coming, I have to get myself in position, what are the big objectives that he or she should be keeping in mind and trying to achieve?
Sure, I'll cover the big objectives in just a second, but I think a couple of principles up front are valuable, and I'll be brief about those. One is they are inevitable, and 2, you ought to prepare for them. And it's my belief that those who prepare for them and have strategies in place ahead of time are going to do better. And in terms of what to prepare for, the first is I'm a huge advocate of a different way of considering risk in an investment portfolio. Typically, it's alpha and beta driving portfolio construction. I've got a different take on that. So one is look at risk differently. Next is be smart about taxes and how to take advantage of the benefits that most governments globally provide to shareholders in the event of loss. And then, of course, thinking creatively about conserving cash. And I think I've got some unique insights here based on the 2 recessions I managed money during.
All right. So let's walk through all 3 of those things step by step then. And the first one there about thinking about the whole portfolio and don't get hung up on alpha and beta of specific companies. Tell us more about what you mean.
Sure, and I think a heuristic is useful, and I've done this exercise with naive investment audiences around the world for over a decade, And I asked them to consider their cousin Vinny, right? Their iffy cousin Vinny, approaching them and asking for $100,000 to open a coffee shop across from Starbucks. And when you ask an audience that question, and you say, what would you ask of Vinny before investing in this coffee shop? They never name things like 250-day moving average. They never mention the volatility in the price of coffee shops, all the things that many of us in the investment business consider. Instead, they ask pertinent business risk questions that are comparable to what businesses themselves have under consideration. So, for example, sometimes they ask about access to capital. They'll talk about, is Vinny right to have as much debt and fund the thing with credit cards, which is the business equivalent of, short-term and long-term debt. They'll talk about the level of equity and how vested is Vinny. They'll talk about the competition. Starbucks is across the street. Economic factors like will people keep drinking, premium blends of coffee in a recession, or will they go down market? They ask questions about their environmental exposures, geographic exposures. Are their employees happy? We recognize all of these because these are the risks that we consider as business people, but for whatever reason in finance, we oftentimes overlook these things. And therein lies an important secret. So I'll give you an example of what I used to do as a PM is I identified categories of these risks, and I've just shared some of them with you in my answer here. And then I would rate them qualitatively based on my understanding of the business from a 0 to a 5, 5 being high risk. And then what I would do is scale that up to the level of the portfolio. So at the individual security level, I'm looking at risks just the way a CFO or CEO of a business would. But then given these individual ratings, you can get a portfolio view of things like weather risk. Now, weather risk is something that most people would overlook. And my example here is that in a traditional, even business analysis risk, you might miss a key risk in your portfolio that's hanging out there. An example I'm going to give is Six Flags. Previously, their ticker was PKS back in the day when I managed money, which was short for Premier Parks, their original company name. And then AES Securities. AES is a global owner of electric power generation and distribution. Now, from the normal way of looking at risk, these have nothing to do with one another. In fact, they might be a good pairs trade because one is in entertainment and the other is a utility, right? So they counterbalance one another. The utility presumably is not economically sensitive, whereas Premier Parks probably is. People cut back on their trip to Six Flags. But they share a risk that is made visible when you look at risk the way business people look at risks, and that's weather risk. So Six Flags performs much, much worse if, in fact, it rains and they have a poor summer. But AES does too because they have hydroelectric power that they own. And if it doesn't rain in the places where they have hydroelectric plants, it also means that you're not going to do very well. So in this way of looking at risk, you can begin to see the different levels of business risk, and then you can also ask hypothetical questions. How will they perform in a recession? And in managing this risk, I thought this was a big secret to my success as a PM is I never was really that surprised by the way my portfolio performed in a recession. And it also allowed me to choose factors that I wanted to be sensitive to in a recession or insensitive to. So anyway, that's a long answer, but I think it's a key point.
Well, it sounds like a very different way of thinking about risk issues and preparing for a portfolio than, frankly, a lot of financial analysts would be accustomed to. I mean, they like getting into the weeds of financial data.
Well, they do, and it's not that that's not valid. That's entirely valid. And in fact, that fundamental work is what drives the qualitative assessment of those risks. So if you've done your fundamental work, you ought to know, for example, how quality is this management? So a classic fundamental question you could ask of your data is, how did the firm perform in the last recession? And that could factor into your qualitative assessment of management. So it's not that the fundamental work is irrelevant. It's just that by looking at risk the way the businesses themselves look at risk, I believe it reveals much more of your sensitivity to problems that arise naturally in a recession.
Okay. Let's move on to your next principle, talking about tax planning. And certainly that is something people think about a lot, but how do you mean it in your specific way here, thinking about recession? What happens?
Well, I'm not sure that I have that unique a take on it. This is kind of a classic thing, tax loss harvesting. The one wrinkle that I will add is that I think it's important for investors to track on a daily basis, if they can, the degree to which their portfolio has securities that are overvalued. And the reason why is that the overvalued ones are most likely going to decline faster in the event of a recession. Of course, my assumption here is that there's a connection between a recession and stock market performance. Typically, in a recession, the market will decline. And if you have awareness of that, and when inevitably there are declines, what you can do is for those securities that are underwater and for which you have losses, the advice, of course, is to sell them. And you can sell those securities and offset them against securities that have big gains, which also then allows you to exit gracefully those overvalued securities. Now, it doesn't always work out that way. Nonetheless, essentially, governments around the world, if they grant you a tax credit for losses in your portfolio, they're essentially subsidizing any of the losses in your portfolio. So it makes sense to harvest those losses, of course. So that's one benefit. But then the other one I will highlight, which is somewhat related, is when you're selling, you don't necessarily want to exit a position entirely. And when you sell, it's often overlooked that you ought to sell your most expensive lots first. So this happens especially at the institutional level, that to put a position on, quote unquote, in your portfolio, you may have had to buy shares over the course of many days, and you want to sell your most expensive lots first because your capital gains will be smaller. So those are my two tips on tax. I don't have a lot original there other than tracking valuation consistently, so you know when to sell and what to sell.
Okay. And then your last point, I know, was going to be your big one, talking about conserving cash. And you specifically are thinking more about how investors can access cash, if I understand it right. What do you mean there?
Well, what I mean is that there's a difficulty, especially in the modern portfolio management environment, where you can't carry a lot of cash on your in your portfolio because you receive a lot of criticism from asset owners who may be your clients. You may also be dealing with investment intermediaries like investment consultants who represent those asset owners. And carrying cash is tantamount to generating tracking error or performance drag. And, you know, it's a classic that if you're a fundamental investor and valuation sensitive, that as you receive new cash inflows, and you don't know what to buy, you're going to start to accumulate cash. Well, that's a non-starter in the modern era where you're competing against very efficient ETFs and other passive products that make that kind of a choice quite untenable. And yet you like the cash because you recognize that it's an inexpensive and free put option if, in fact, the market declines in a recession, meaning that your portfolio is going to decline much less in value if it has a high proportion of cash. The timing is tough. But my point is that there are indirect ways of putting cash into your portfolio. The first one is to buy securities that actually pay a dividend. And many companies do pay a dividend, but not as many as you would think. And so that's the first tip, is buy companies that issue dividends, because that's a way of purchasing cash into your portfolio. In addition, companies that pay dividends tend to be economically a little bit more stable, which is why they believe that they can afford to pay a dividend. So chances are you're going to have lower volatility in the price performance of those shares, but then they're also going to pay you cash, which may fund additional purchases. Because ideally in a recession, in market decline, you would like to be able to put that cash to work. You'd like to buy something, and the question is, where can you get it, since you can't carry a whole lot of it without underperforming if the recession doesn't happen. So the first tip, purchase things that have dividends. The second is fairly related. If your charter, meaning your prospectus, allows you to invest in assets other than stocks, you could also load up on debt that pays coupons to you. So that's another way to harvest cash into your portfolio. So to summarize that bit, if you have a 5% yield, that's also 5% cushion on the downside. And if you're in a highly competitive category as an investment manager, that 5% extra performance is almost pure alpha for those who have low cash balances or assets that don't pay dividends or coupons.
Mm-hmm.
So the next one, and this one is a little bit indirect, and Matt, I know you have a slide on this, is to purchase shares of companies that have high cash balances themselves. Yeah, perfect. Yeah, so here's a perfect example of how Calcbench, by the way, can help you with this point I'm about to make. You can indirectly buy cash balances of businesses by buying companies that carry a high amount of cash. And so right here, conveniently on the left-hand side, you can see the companies that have the largest piles of cash. And on the right-hand side, highest cash to assets ratio. So if I buy shares in this company, I know a couple of things. Eventually, investors will catch on to the fact that these firms have high cash balances. Ergo, the prices ought to be a little bit more stable in terms of their performance. But then in addition, these companies have really high levels of flexibility to manage their businesses in the event of a recession. So you can imagine in a business that's highly competitive, the one that has more cash can pick off and purchase shares, that is to acquire companies that aren't performing so well. Additionally, that cash allows them to buy back debt, which reduces the level of the expenses in the firm. Ergo, earnings are a little bit more stable. If the earnings are more stable in a recessionary environment, probably they're going to outperform. And then the last bit is they can return some of that cash to shareholders in the form of dividends or stock buybacks. And so this insight is one that's often overlooked is, okay, I'm a portfolio manager, I'd like to be fully vested, so I can't carry cash, but you can actually purchase cash indirectly in this manner if you just change your mindset slightly. So well, that's the last bit.
I think that's a great point, and I am just curious, do you have any thoughts about why investment managers out there might not necessarily have that perception in their head about an easy way to sort of sneak into cash and get it into the portfolio? Like, why don't others think of this?
Well, I'm not unique in this. I've seen it several times over the years that other people have talked about that secret. As to why more investment managers don't, I don't necessarily know. I have a hunch and a suspicion. In my conversations with investment managers, the first thing is they've never really prepared for the recession ahead of time. They may anticipate one, and to the degree that they're really preparing, they might be looking at stocks they'd like to buy. But the cold, hard reality is you get a wave of redemptions typically in a recessionary environment, and you don't necessarily know what to do. So if, in fact, you sell to fund those redemptions, take advantage of the tax loss harvesting, which we just said, but then you kind of prepared yourself in advance for the recession by switching into assets that have this cash, which should make the portfolio a little bit more stable. So that's the first point. They don't necessarily plan very well, and they don't anticipate. But then secondly, I think that the general obsession of fundamental investors is to find the outperformer, and that version looks like to the upside. And so a growth manager, of course, is looking for firms that are going to outperform in terms of their either revenue growth or earnings growth or EBITDA growth or whatever measure they're looking at. And so they haven't necessarily thought about how to outperform the down market. And for the value managers as well, they're typically looking for shares that are on a fair value basis, that's their valuation, are higher than the actual market price, meaning that there's a margin of safety in there. And they're looking also on the upside bit. They don't necessarily look at it on the downside bit and anticipate, oh my goodness, who might I be able to buy in this way? So I can only chalk it up to those two things. They don't prepare, and the overall mindset is fixed on upside and upside performance rather than performing on the downside.
Okay. Well, Jason, that's all the time we have today, but you covered plenty of ground for us, gave us a lot to think about. So thank you very much for your time. This has been great.
My pleasure. Thanks, Matt.
Again, everybody, that was Jason Voss. He's the CEO of Active Investment Management Consulting, and he joined us today to share his thoughts and principles on how to prepare the portfolio for possible recession. Now we're going to pivot to part 2 of this webcast. So this is where we're going to talk more about Calcbench and how its data analytics capabilities can help you with some of the principles that Jason Voss just articulated for us. Joining us to understand all of that is Pranav Ghai, CEO and co-founder of Calcbench. Pranav, welcome.
Hi, Matt. Thanks for doing this for us today.
For those of you not familiar with Pranav, he was one of the co-founders of Calcbench in 2011, and he has been CEO of the company ever since. Earlier in his career, Pranav also worked at Morgan Stanley, TIAA, and ITG. Aside from his day job running Calcbench, Pranav also sits on the board of XBRL US, and XBRL is the data tagging technology that makes a lot of today's sophisticated financial analysis possible. And Pranav also serves on the CFA Institute's Corporate Disclosure Policy Council. He's a member of the Technical Computing Advisory Board for Microsoft, so he certainly has all the expertise. Pranav, before we get into all of the details of Jason's comments, could you just give us, give us the elevator pitch about Calcbench and what it provides?
Oh, sure, Matt. Calcbench is a what we call a next generation financial data tool. Mm-hmm. We take all of the corporate filings in the US, as well as, believe it or not now, IFRS filings for those companies cross-listed in the US, and there are about 600-700 of those at this point. We take all of that data that comes through 10Ks, 10Qs, and now we take a lot of 8K data as well, so earnings press releases, and we put it through our engines. We then render it back to our clients for them to use. So you can look at a single company in detail, whether that's a face financial statement like an income statement or a cash flow statement, balance sheet, etc. And you can look at how they filed the data on an annual or quarterly basis. You can look at, and then you can extend that from a single company to multiple companies and look at large indices like the S&P 500 or your own custom group of companies, and come to a have data to support whatever argument you had, and then our clients use it to quickly look up footnote information as well, so you can ask questions with respect to the Tax Cuts and Jobs Act, which we've done over the last couple of years and written about on our amazing blog. And you can go, you don't have to take my word for it, you can go read about things on our blog and see how we or other clients are using the data. It's data that's been around for a long time, but people are always looking for new and novel ways to use it, and we help in that process.
Okay, so now let's talk a little about what Jason had been mentioning in his part of this podcast. First, he had talked a lot about risk factors and studying risk factors generally rather than rushing into financial analytics. So what does Calcbench offer here for users, helping them to study those business risks? What are we staring at on our screen here?
Oh, that's a wonderful question. Thank you to Jason for bringing it up, and thank you for helping us to discuss it. So the risk factor is a disclosure inside the 10K or the 10Q. So in the old days, you'd have to, something simple, in order to get the risk factor, you'd have to pull up the entire document. You'd have to find the risk factor, which can vary in terms of where it's placed, on a company basis. Mm-hmm. And then you'd have to go and, maybe read it, or, maybe manually pull information out of it, where the company discussed, these market conditions, or they put other kinds of geopolitical factors in to the mix. And then you'd have to say, well, look, these guys at company A are talking about this. Companies B, C, and D, which are also in the same industry or same sector, how are those companies disclosing those same risks? And so you'd have to then pull up the same risk factors for companies B, C, and D. And I'm talking about it, and I'm just getting exhausted thinking about the amount of work that you'd have to do. Today, using Calcbench, that idea or that task that we outlined just a minute ago, it's actually much, much easier. You can actually go into the disclosures and footnotes query page, which is what we see in front of us. You can pick a peer group, you can design your own peer group, or you can, in this case, you can look at a standard set of companies like the Dow, and you can say, look, for their 2018 10K disclosures, give me all the risk factors. So you've basically pulled out, the analogy is I pulled out chapter 3 out of 30 companies, and I'm only looking at chapter 3. So I can literally click through each risk factor and I've got it there in front of me. I can do something as traditional as reading that risk factor and then clicking through the next one. So I don't have to worry about where these things are in the document. I'm assured of getting them. Mm-hmm. And then you can take that and you can go any number of ways with it. You can look for specific data tables inside those risk factors, pull that information out, run numeric analysis on it. You can even do something more novel, and this may be unique for some of our users, but you can do text differencing using some artificial intelligence processes, etc. Right on Calcbench, actually, where you see compare to previous period in this slide. Yeah. If you were to actually click on that, it would take your current risk factor for the company and black line it, red line it, whatever, with the prior risk factor. So you can do some comparing that way as well.
So you can see what companies have said about risk factors, how that has changed from year to year or period to period over time.
That is absolutely right. And there are other more advanced techniques that people can use, and we've implemented a few of them for clients. There's something called term frequency, inverse document frequency, TF-IDF, and if somebody wanted to go and just do a search on that, while they're listening to our podcast here, they could simply do that. You can actually apply those same techniques to corporate disclosures, and very, very quickly. The idea there is that you're taking a list of companies and you're saying, okay, look, which of these companies is on a quick basis, who's changed their disclosure, who's changed their risk factor disclosure the most, and you can actually get a very, very quick bird's eye view across several companies, and then you can take that report and sort of hone in on the one or two that you really believe are the ones that are the outliers.
Mm-hmm. And now let's move on to Jason's next point. He had talked a bit about tax management. And so we have on our screen here, I think, a couple of different tax items that Calcbench does track, but I don't know if you just want to walk us through in detail a little more about what are the data points people can pull out related to taxes? What can you do with this information?
Oh, sure. So we can talk about, just like the risk factor disclosure, there's an income tax disclosure inside of all of the 10Ks and 10Qs that companies present. Within that document itself, there's a plethora of data in the tables, in the paragraphs, and you can glean quite a bit of information from those tables. And it really gets powerful once you start comparing companies across time and with each other. Some of the especially when there are big legislative achievements that have occurred, like the Tax Cuts and Jobs Act from 2017 that had its first inklings in 2018 with things going on. One of the things that people historically have focused on are what are sort of the deferred tax assets that a company might have. And so what you see on the slide to the left is all these deferred tax assets, both assets and actually the liabilities. How much is sitting there for these companies to, possibly use into the future? And so an example of a deferred tax asset specifically would be an operating loss carry forward, which is what you see on the slide to the right. So for example, you are a company and you incur a very simple case of operating loss, a net operating loss carry forward. You incur a a loss in a particular tax year. So you did not make enough money to cover your expenses. A very, very simple case. There are other circumstances, but that might impact that. But in that case, you take that loss and you just say, okay, look, I'm going to carry that loss forward to some other year when I do have a gain that I can then offset that against. And so we keep track of all the corporate operating loss carry forwards, and you can get that with a mouse click inside our tool. And you can then figure, okay, the company might, if they actually have they have an operating they have a gain, big net income gain, they might be able to offset some of that, or they probably will have at that point, through some of the losses that they had in prior years. And those things have value. So you can use those in a, you can use those in a discounted cash flow analysis. You can use them in some kind of valuation process. And the point is that you don't have to, again, dig through multiple documents in order to get that information. You can get it and have confidence that what you're getting is the correct number, because one of the things that we also do, in addition to just providing you with the data, we provide you what we call trace links, which are pieces of code that would sit in that table there, and you can click on it, and what you get the source document back in front of you. So you have confidence that what we're telling you is high quality, so that that number for Hewlett-Packard, the $31,278,000,000 number, if you were to click on that number, it would take you to the disclosure where that number resides, and you can reconcile it.
And that's pretty much every number that we find in Calcbench. I've used this feature myself, basically. So, you can run your mouse over the number and a little box will pop up next to it that says trace. And that's essentially how it works.
That's exactly how it works. And that is in our Excel add-in, you can do something similar with the right mouse click. It will open the source document inside the Excel add-in as well. And it's really, really, really powerful. It's a simple thing, but it gives people confidence that yes, that number is in fact what we claim it to be.
All right. So then our last issue that Jason had talked with us about was cash analysis, and he thought this was very important. So tell us a bit about what the metrics are out there related to cash that people can play around with. What can they do with all this information?
So cash is one of these great items. Very, very simple in the sense that it's sitting right there on the balance sheet, and it's one of those things that companies are criticized for, like, oh, cash hoarders, they're sitting on way too much cash, et cetera, et cetera. Well, we, in my old life, we had we would sit around with C-suite executives a lot, and we still talk to a lot of them at Calcbench as well. And you ask them, off the cuff, hey, why do you have so much cash? And they kind of look at you and they kind of, they say, because stuff happens, right? You just need, it's a corporate security blanket. And so what you can do here, this is a really good thing. You can get cash balances for a large group of companies. Here you've got it for the Dow, and in 2018 you're looking at cash balances on average. That average number is over $12 billion. So that is not a short-term investment number. That's cash. That's how much cash on average these 30 companies have on their balance sheets. So the idea is now you can look at that number over time. You can ask yourself, look, is 12 billion way too much for these companies? Are they going to get acquisitive? What's going on? As cash yields drop to zero, what are they going to do with it are they going to return it to the shareholders, et cetera? And that, just like we said before with the tax assets, you can trace all of those numbers back. You can now add cash, for example, with the short-term investments and compare those, because they are different things. Companies can buy short-term treasuries, etc., and they've got them housed elsewhere. They're also a liquidity asset that can be drawn on in times of need. But these are significant numbers that you're seeing here, and so we give you the ability to simply track them.
And
I mean, it's a big number.
Jason had brought up that you need cash for things like paying dividends, buying back stock, and whatnot. You guys track all of those individual types of metrics too, right?
Absolutely. So share buybacks are tracked over time. The amount of dividends, both cash and stock dividends, are tracked over time. You're able to look at a single firm or multiple firms very, very quickly.
Mm-hmm.
So all of those things are available to our users. There's almost too much to talk about. So it's if you've got a use case that you'd like to talk to us about, we'd welcome your input as a user.
All right.
Just call us.
Well, that's pretty much what we had here today, but Pranav, you gave us plenty of information, so thank you very much for your time.
Well, thanks, Matt.
And again, everyone, that was Pranav Ghai, co-founder and CEO of Calcbench, walking us through how you can use the site to research firms' financial performance. And earlier in this masterclass, we were joined by Jason Voss, CEO of Active Investment Management Consulting. He gave us plenty to think about how to prepare your portfolio for possible recession. So that's all for this masterclass. If you have any questions, please send them to info@calcbench.com and someone will follow up with you promptly. Otherwise, I've been your host, Matt Kelly. Thank you all for listening and have a good day.